Hey everyone, welcome to my channel Beyond Balanced Books. In this episode, we are going to go over the matching concept, the what, the whys, the hows, and the limitations of this concept. In the previous episode, we went over the accrual concept, and I might go back and talk about that in this episode as well. So please, if you haven't watched that video yet, I suggest you go ahead and watch that first before you start. So, this concept is based on the understanding that a business has to incur expense in order to generate any kind of income, and both income and expenses are booked into the P&L. So, let's first understand what's income and what's expense. Income is what you receive for any product or service that you sell, whereas expense is all the items that you spend your money on in order to generate that income. For example, if you are a restaurant, you spend money on labor, you spend money on buying the food, the ingredients. All of that money spent on this is your expense. Now, the matching concept says that if you book an income in an accounting period, all the expenses related to those income has to be booked in the same accounting period. So the matching principle is actually helping the accountants to identify what expenses to book in what accounting period based on when the income is being realized. And if you remember, if we go to the last episode about the accrual concept was actually guiding the accountants into figuring out when to book a transaction as an income or expense. So both of these concepts align with each other. They basically give us the same result, but at the same time, they are giving us two different um, scenarios, or like they are guiding us through different um, perspectives. So this is how the concepts are aligned, but at the same time serving two different purposes. So why is this concept important? As we all know, the profits are calculated as a net of income and expenses. So basically, income minus expense is your profit. So if the expenses are hidden or the expenses are pushed into the wrong accounting period, then a financial statement can be overstated in its profits, and there will be room for such type of manipulation in the books. So what this concept does is it uniformly tells us how the expenses need to be booked so that there's no room for such type of manipulation, and the financial statements become more accurate and more consistent. So instead of the house, we are going to go over a few examples in this topic. The first topic I have picked is the bonus, because a bonus is usually a very, very common thing, and it's usually based upon past performance or past revenue. So, because it is based on the past revenue, it has to be booked in the period that revenue was generated. So, for example, if my bonus is based on the first quarter of the year, although I might get the bonus in April, the bonus should still be booked in the first quarter of the year instead of booking it in April. So that's basically what the matching concept says, is that if you generated the revenue, the expense related to that revenue has to be booked in the same accounting period. The second example I have on here are commissions and event expenses. These are also directly related to the revenues generated from the events or the item that the commission is linked to. So, because of that reason, the commissions also have to be booked in the period the revenues were generated. Similarly, the event expenses, let's say an event for restaurants, for example, they have events, and the events are going, one of the event is going to happen in May, and we incur some cost for that event already in April because we have to pre-order some stuff. Even though we do the pre-ordering, because the event is not going to happen until May and the revenue is not going to be generated until May, we won't be able to book that expense in April, although it we actually paid for it in April. So the next example I have over here is the depreciation. Depreciation is a non-cash expense. For accounting purposes, we usually determine the useful life and the scrap value of a fixed asset. For example, if we have a cookie making equipment, we will use that cookie making equipment until its useful life. And what we do is each time we make the cookies, it loses value, and that loss of the value is what we book as depreciation in the accounting financial statements. And matching principle allows us to connect the loss of the value of the equipment with the generation of the cookie in this example. So this also was possible because of the matching concept. I went over all the importance and the good things about the matching principle, so I cannot not mention the limitations of matching principle as well. So, one of the biggest limitation is that not all revenue can be easily linked to expenses in real life. For example, the pre-opening expenses when a restaurant or when a business is trying to open, they might start incurring expenses before the revenue is even generated. So those type of costs, it's very hard to link them into the revenue and expense. The matching can't be done. Same thing with the advertising and marketing, because you are doing that for a future benefit, right? So when the revenue, whether it goes up or not, it's not known ahead of time, so it's hard to match those revenues with the advertising and marketing. Same thing with the R&Ds. When the research and development is done, we don't even know the product is going to actually go into the market, so that's hard to match as well. When big structural changes are done or office moves to a prominent place, we don't really know that is actually going to bring into fruition the. And with this, we are done with the matching concept. Thank you for watching this far. And if you have any questions, comments, feedbacks, please make sure you put that in the comment section, and I'll try to incorporate as much as I can into my next video. I will be back with the next video in the next week or so. That's the goal, to get one out every week. Thank you so much. Bye bye.